Welcome, everybody, to Supercritical, the podcast that makes deep tech simple. It's your host, Luigi Di Piazza. Today is a special episode. We're kicking off our investor series, where we dive into how leading VCs build conviction, navigate uncertainty, and help shape the future through deep tech. I'm excited to introduce our very first guest in this series, Leo Polovets, co-founder of Susa Ventures and general partner of Humba Ventures, a pre-seed and seed fund focused on deep tech and American dynamism. Leo, welcome to the show.
Thanks, Luigi. Really excited to be here, and hopefully we can kick off the series well. I'm really excited to be the first guest.
Absolutely. I couldn't be more thrilled. And I think I'd love to start with your lens on the world. What's something you believe about the future that most people don't yet think or believe?
That's a good question. To be honest, I think in this job, I get surprised about so many things in so many industries. So a lot of the beliefs are less like I came up with a belief and then nobody else has it. It's more like kind of form my beliefs a lot of times from what I see through founders. I would say probably the biggest one right now is I just feel like a lot of physical industries are going to just be reinvented in the next 10 or 20 years. I think robots are getting to the point where they're more and more efficient, they're more and more affordable, like they can be programmed or taught to do tasks quickly. And so it's just hard to believe that's not going to, proliferate throughout a lot of industries where there's either no automation or maybe there is automation, but the automation's like 30 or 50 or 100 years old. So I think that's like something that's going to happen for sure in the next decade or two.
Yeah. And I guess, would that be kind of your secret bet, like a thesis or market or even founder trait that you're incredibly bullish on?
I think it's less of I'd say it's less of a secret bet. It's more of like a big area of focus. In terms of founder traits, I like, I'd say I like all the ones that other investors like, like founder market fit, high grit, smart, all of that. Probably a couple I really like to see is one is ideally the founder is like really exceptional in something. And I'm talking more like, 1 in 10,000 people, not like 1 in 50 people exceptional. And usually that's like some past achievement they have or like some combination of skills. The other thing I really like to see that I think is unusual, or that people don't talk about much, is like intentionality. Uh, I think there's a lot of companies that are built where, somebody's kind of just like on the fly making decisions like, oh, let me try this, let me try that. I really like founders where they try to kind of pre-analyze a lot and pre-game a lot and think about, okay, here are like my 7 options. Let me see if I can think of any others. Let me see what are the trade-offs of each option. Like what happens if I do each thing? And then by the time they pick something, even though they might pick it very quickly, they already kind of have the world mapped out and they have good reasons for why they didn't do the other 6 options. And I like that sort of founder a lot.
At what point does that pre-game come across and you're getting to know the founder? Do you realize that like as you get to know them better and better, or is it kind of right off the bat they kind of present that worldview?
You usually have to dig in a little bit, but honestly, it's not too hard. It's basically just asking why, right? So it's like, oh, you're based in Atlanta, right? Like, and you're building a biotech company. Like, why are you based in Atlanta, right? And I think a good answer is like, well, like even though biotech's mostly in San Diego and Boston, there's this one lab here that is like world experts on this thing we do. We can like hire from them, blah, blah, blah. That would be a good answer. I think a bad answer is like, well, like I grew up in Atlanta, like I like it here, like I don't want to move. And then like that's a good answer personally, but I don't think that's a good answer for the company. And it kind of shows that maybe you're not thinking about maybe not thinking strategically about like what should my location be, and maybe that means you're not thinking strategically about other decisions as well.
Why deep tech and American dynamism?
Yeah, I mean, I think there's a confluence of factors here. I think one is, I used to be an engineer for about a decade before venture, so I like the more technical stuff in general. Like I love learning about it. I think the technology is just so cool, and there's like so many areas that I'm unfamiliar with, but like getting familiar with. Um, I think the talent in this space right now is just like really, really good. There's a lot of people, coming out of SpaceX and Palantir and Tesla. They're very ambitious. They're like working on big problems. So I think all of that is very exciting. And then from a business standpoint, I think a lot of these businesses, because they're hard to build because of like the physical component, and like kind of the multiple like areas of skill you need to go build something. Like it's not just software. Maybe it's like software and mechanical and electrical and something else. So because these things are hard to build, I think there's less competition. I think you can capture value better because there's less competition. I think once you get a head start, the moat becomes a lot stronger because even if somebody tries to copy you, they need a couple of years just to figure out what you're doing. So I think from a business perspective, these are great investments to make.
Absolutely. Do you see any parallels maybe in like kind of the maturity of the market or the between maybe like 10 years ago and traditional, call it like B2B SaaS or like traditional venture sectors and the current moment today? Is the energy similar? What's your take?
Yeah, I do see some parallels. I would say like maybe I'll pick one on the investing front and one on the building front. On the investing front, when we started Susa 12 years ago, it was very collaborative. There were a lot of smaller funds. Most of them had not grown up yet. So all of the rounds were like collaborative. You want to invest. You kind of, try to introduce all of your friends to the company that you think highly of and see if they want to invest. And if you fast forward 10 or 12 years, like a lot of those funds grew up and now they're like a bit more sharp elbow and competitive. And like it just feels like a very different investing atmosphere if you're, if you're investing in SaaS. Um, Deep tech to me feels pretty similar on that front as an investor, where today it's a lot of smaller funds and very few large funds. And so it feels very collaborative and like kind of very collegial in a very positive way, where, investors are like, they're investing, they're trying to help the founder find other good investors. They're like sharing, companies with their network instead of trying to conceal everything until, you get your allocation. So it feels like a very like nice, positive thing. Um, on the founder front, I think probably like the thing that to me kind of mirrors SaaS 10, 12 years ago is if you're building a SaaS company like 15 years ago or 20 years ago, there's very little content on it, very little like know-how on the internet. And then I think about 10 years ago, that really exploded. Right. So you had these awesome blogs like SaaStr, but you also had people, blogging about like pricing and go to market and, conversion rates and just like all kinds of aspects of building a SaaS business. And so now if you start one, like it's just like a very well documented thing where it's not necessarily trivial to build, but there's a lot of things that you can learn about without having to like make mistakes along the way or just kind of fly blind. I think deep tech's kind of similar. Like if you right now there's not a ton of content, but I think it's really starting to grow. Like there's trying to be more interviews, more videos, more how-to guides on, a lot of aspects of building deep tech companies. Like how do you actually, scale like a fermentation tank or like how do you get permits for something or how do you get a SIPR grant? I think, 5 years ago, you kind of DIYing that stuff, or maybe you could find a founder or two that's tried it before. And I think increasingly there's just there are more and more resources online for that, which I think is terrific.
Yeah. And as you speak with more and more founders and you get exposed to all these different challenges and problems, uh, I mean, if you could solve just one deep tech problem, what would that be and why?
It's a good question. To be honest, I don't know how to answer it, right? Because it's like, do you want to solve like world hunger or like abundant energy or something else? Like they're all super important. Um, I would say like on a personal note, I'd love to see more companies tackling like autoimmune disease. I think it's one of those areas that affects a lot of people, but it's sort of silent, right? Because it maybe like incapacitates you to some degree, depending on what you're suffering from, but it doesn't kill you. And so it just ends up being lower priority than like all the things that could kill you. But in essence, it doesn't, I don't think it gets the attention it deserves. Um, I think the other area is like, I think energy is a really big one because it's an input to so many things, right? Whether it's like data centers or robotics or transportation. And so just like the more we get to like cheap, easy to dispatch, safe energy, like I think the more it helps all the other industries that need energy, which is basically every industry.
Absolutely. It's the most essential. At the end of the day, you go back,
It's like Maslow's hierarchy of needs, but for like, like productivity or something, right?
absolutely. It's so important. And I guess like speaking about trends, it's, what are, in your opinion, some deep tech trends that are still, you think, kind of misunderstood or maybe even underhyped today? And on the flip side, what do you think is a trend that is maybe overhyped?
Ooh, that's a good question. Um, VCs don't like saying overhyped things because I think they kind of assume that, any founder in those spaces will just not want to talk to them. um, that said, I do think humanoids are kind of overhyped. The way I see it is like you basically have like humanoids and then you have like use case specific robots. And humanoids are good in an environment where you have to do like 50 or 100 things and you don't want to get 50 or 100 specialized robots or maybe 1,000 if it's just like the robot has to be able to do anything. And so humanoid's great for that, right? Like maybe it's like somebody helping you around the house, right? And there's just so many different tasks to do that you want one general purpose robot instead of 100 different robots in your house. I think for most applications, especially industrial ones, you probably just want more like vertical specific robots where it's like, hey, this thing just cuts wood in like, in a square, or like this thing just, like sands a piece of metal. Because those kinds of robots are just, I think they're often orders of magnitude more efficient than a humanoid. Um, and so I think that's kind of my answer to both of your questions. Right? I think humanoids are kind of overhyped. And I think these sort of like very use case specific robots and automation strategies are underhyped. Um, and I just like, yeah, I think kind of anywhere you look around you, like it was probably made by hand or mostly by hand. And so like a lot of that stuff can and should be automated over time. But I think the way to do that is through use case specific robots versus something very general purpose.
I'd love to dive a little bit on your war stories. To start off on this section, I'd love to, if you can tell me about a deal that really changed how you think about investing. Maybe something that forced you to rethink your approach to timing, conviction, founder dynamics. What comes to mind? I know you've had such a long career. Maybe something that is both applicable, like in both your hats as a before it's Susa, and maybe has that lesson changed once you've stepped into Humba?
Um, it's a good question. I think a lot of my the probably like the area where I've changed my mind the most, or kind of like my thinking's evolved the most, is just on founders. Because I coming from engineering and being an engineer where I'm probably a better judge of like a product than a person, or like a better evaluator. When I started at Susa, I really focused more on like, is this a good product? How do I think it competes with other products? And obviously, like I try to understand the founder a bit, but I focus more on like the product and the product strategy versus the team. And then over the years, like I just, there were a handful of times where I'd see what a difference like, a strong founder makes. Um, and I think actually like the two deals that came to mind, these are actually like small angel investments I did like 4, 5, 6 years ago. I invested in these two companies. Uh, one is called Lindy now. One is called Hightouch. So Lindy's like a leading AI agent platform. Hightouch is like a $1 billion+ like basically like a data warehouse stack company. Um, and and both of those, the founders were really awesome, and they pitched completely different ideas at the time. And I like those ideas, and I like the founders, but I think just seeing them navigate like a changing environment really well, like cemented in me that like obviously the idea matters, and hopefully you like the initial idea, and the company won't have to pivot. But you also want a founder that's like resourceful and fast and sharp enough to like go pivot when they have to and pivot to the right thing. So High Touch is a good example of this. Like this started out, it was a company called Carry Travel. I met the founder, Kashish, like I think it was a little bit before COVID. Like I liked him a lot. They were doing like really like easy travel planning software for corporate clients. And I ended up doing an angel check. And like 6 months later, COVID hit. And I think most of the companies I saw during COVID that had a business model that was affected by COVID, they would just try to like grit through it, right? They're like, oh, we sell to restaurants, restaurants are closing. Like if we just cut burn and last for a while, like, we can make it work, or like maybe we can pivot from like restaurants to something adjacent to restaurants. Kashish and the Carry team were basically like, hey, travel planning just seems like it's dead for a while. And we've been working on this for 6 months, but like, it doesn't have a good future. Let's just shut it down and experiment. And so they did a couple experiments, and High Touch was one of them. And then in like 3, 4 years, they went from, seed stage company to like $1 billion company with like and not like a hyped up billion, like they have like real revenue that's significant and growing quickly. And so to me, that was like, a good data point. Like, man, the founder really, really matters, right? Because sometimes things are straightforward and the company just grows. And then other times, if things are not straightforward, you want someone that can navigate that as well as possible.
Absolutely. And how do you think that applies with this lesson to deep tech and maybe to hard tech application or solutions or problems?
Honestly, like a bit more of the same. Um, like a couple, obviously I love all the founders work with, a couple that I think, and I would say each founder probably stands out in at least like a dimension or two. Um, One dimension I think is pretty interesting is like founders that sort of understand the full stack of a complicated business. And I think the really like the world famous one of this is Elon, right? Where, he's like thinking about the business, but also he can talk about like the chemistry of rocket fuel or like the physics of, like the car engine. And he can just kind of go at any level of detail about almost anything in the company, or at least it seems that way. So like a couple of the founders I work with at Humba like that, there's this guy, Charlie, who runs Orchard Robotics. He's really young. He's early 20s. I think he was 19 or 20 when we first invested. They're building cameras that basically get attached to like a tractor or truck on a farm. And then as the farmer goes about their day, um, the camera captures a lot of video on like what's going on at the farm. And then you could use all of that data and analyze it and give the farmer like good recommendations of, how to optimize their yield and like where they need to like watch out for disease and that kind of stuff. So that's what the business does. But what really impressed me about Charlie is like I said, he was really young when we met, and it's like you could ask him about like detailed hardware questions, software questions, like the farming industry, business strategy. And it wasn't like, oh, I know this part, go ask my founder about the other two. It was like he kind of knew everything and he could drill down as deep as you want. And so I thought that was like just very unusual and just like a really strong founder quality. And he's done really well with that business, even though ag tech's kind of a hard industry. And then similarly, there's another guy, Jordan, who runs Antares, which is like a nuclear microreactor company. And it's similar where they're selling reactors for defense applications. And Jordan he had White House experience. He was CTO of a company that's since raised something like $100 million, although it was not deep tech. And he had like a physics background from college. And so it's kind of like, here's a business with a lot of complexity where there's a government defense angle, it's a startup, there's like a physics and hardware angle. And he had experience across all three, and he had like, and insights across all three, and could talk about all three at different levels. And that's another company that's continued to do super well, where we led the pre-seed. There is a seed, there is a Series A. I bet they'll raise again soon. And they're just like, they're doing super well. And I think it's a reflection of the founder, and like just how well-rounded they are for their business.
Hmm. I guess looking back, what's a deal that surprised you in the way it maybe played out? Is there a case that like kind of stands out?
I don't think I want to name names for this one, but I would say like, I think one thing that has stood out to me over time is I think being a serial founder is somewhat overrated by the market. Um, and what I mean by that is like, I think serial founders are often better equipped for a startup than like a first time founder. But I think they're like 10 or 20 or 30% better equipped. But sometimes like the valuations in the early days are, they're not 10 or 20% higher. They're like 2 or 3 or 4x higher. Um, and I think a lot of times, like basically like how successful you are in your second company is only loosely correlated with how successful you are in your first. And so I've seen founders where, they've started a company that's scaled super far, and then they start a second one or a third one, and the second or third one like don't do nearly as well. And it's not because the founder is like not hungry or not working hard or they don't have a good idea. It's just I think there's some element of like luck. There's some element of like picking a good market to startups, and sometimes it feels like a good market, but it's not, or there's like some key ingredient missing, and even serial founders like really struggle with that. And I think the market sort of like overvalues them at like the pre-seed and seed stage, um, like more than it should, basically.
In deep tech, things I believe rarely follow the plan. How do you personally define success when maybe outcomes are long term or nonlinear?
It's a good question. I think it's honestly kind of similar with traditional tech companies. We we've had companies where it's just like up and to the right from day one, and that's more unusual, but it certainly happens. And then we've had ones where like there's one company in the portfolio, that's $1 billion plus right now, is like an early investment we made at Susa. Um, and I don't remember the exact timeline, but I think there is a Series A very quickly after a seed round, maybe like a year after a seed round. And they're actually like working on hardware, and I think it took them like 4 or 5 years to perfect the hardware. And we thought the Series A would be like, hey, you continue refining this for a year, you go to market, and then you'll raise a Series B in a year and a half. And it took like 5 years, which is kind of an ungodly amount to make one round last. Um, but then once they perfected their hardware, the business really started taking off like a hockey stick. And that was where, and then they raised like a great Series B at $1 billion plus valuation. Um, but like, yeah, like, I mean, I saw this like on the software side as well, where it's like, there were companies where, it's like seed Series A, Series B within a year of each other. And then sometimes they fold after the Series B because it turned out the business wasn't working. And then other ones where, things are lumpy and like maybe the business like stalls out at points or like the market doesn't work at points. But in the end, they persevere. So I think in general, like it's just long-term and nonlinear everywhere. I think for me, like in the personal sense, what I want to feel like is like, I can help in some way or move the needle in some way. That's kind of what makes me happy, right? Where it's not like, oh, I gave you a check and then hopefully you do something with it. So like, I gave you a check and then, I'm going to try to help and maybe I can't. But if I can help you like find some additional investors when you really need capital, or I could help you like reframe your thinking about some problem that gets you to a better decision. That's what makes me feel good and sort of, I guess, like non-fungible as an investor. And then at a portfolio level, I think on the deep tech side, like we're basically making, 40-ish bets every fund that are in like ambitious, hopefully world changing ideas. And I'd love for all of them to work. I don't think all of them will, but hopefully, I think if at least a couple work, that'll feel really good. Right. Which is like, we help fund a lot of companies. We maybe help them get other funding partners in the early days, help them get off the ground in that sense. And then if like one or two or three of them end up like changing the industry or, like making things better for people or companies or countries, like I think that's like a really exciting and satisfying thing in the long run.
Thinking about founders, what do you wish more deep tech founders understood about the fundraising process, and both like at the various stages as you're seeing them mature from pre-seed all the way to, Bs and growth?
Um, that's a great question. Maybe two thoughts. So one is, I think there's a tendency to want to game the process because it's like, I was like, people don't like fundraising. It can take a while. There's a lot of no's. Like it's not, like some people enjoy it, most don't. It's not that fun. Like people would rather be building whatever they're building. And so sometimes people try to game the process, right? They're like, we'll do an investor week, or we'll try to, create a deadline, or we'll create time pressure, or we'll exaggerate progress with other investors. And most of that stuff doesn't work. And in fact, I would say most of it backfires. Um, and so, it's like if you tell somebody, for example, like, hey, Luigi, I'm talking to you, like about you investing. I'm talking like 5 other funds. I expect my first term sheet in a week. So you better move quickly. Like if you don't move in a week and then I don't have any term sheets, like it just puts me in a much worse position. And if like you probably want to just pass after that because you feel like I'm trying to just like kind of like manipulate you. And so I think that's one piece, right? Like don't try to game things. Like it's just, the process sucks. You have to go through it. It's high ROI, right? You might spend, I don't know, 300 hours raising like a $3 million seed round, and 300 hours is a long time, but that's like $10,000 an hour, right? So like, it's pretty good. Um, so I think that's one piece, like don't game the process, just like try to do your best, but like in a normal way. The other one, and I think this one applies across stages, is you have to know your audience. So like, for example, like I'm technical, but I'm not an expert on a lot of areas. And so like, if you're pitching me a bio company, you should pitch me at some technical level, maybe some like higher mid level, but you don't need to go into like the kind of detail that only a bio PhD would know. And a lot of times I get, like some pitches are at that right level. Sometimes it's like way too technical where I'm trying to follow along, but to be honest, like I'm just not well equipped to do that given what I know about biology. Other times it's the opposite where I could tell somebody's like really dumbing stuff down and like I really want to get like a little bit more detail. Um, and so like there's a know your audience in a technical sense of like, depending on how technical the person is and how well they know your space, like you should kind of adjust how deep you get or how detailed you get. I think the other know your audience is, hey, if you're pitching like a $3 million seed round, you should probably talk to seed funds and not multi-stage. If you're pitching like a $10 million seed round, you're probably wasting your time with most seed funds and you should talk to multi-stages. And I think like sometimes like people sort of pitch whoever they can without realizing that some investors will be a good fit somewhere and others won't. I think that ends up being a waste of time for both sides.
How quickly do the deep tech deals move compared to maybe traditional software deals in your experience so far? What's a sense for like maybe a fast deep tech round? Is it the same as, we're closing in 3 days?
Don't see a lot of those unless it's like very, very unusual, right? Like if, if somebody previously exited, like, back to like the serial founder thing, like if somebody previously sold like a $200 million robotics company, they'd probably have like a very fast seed round. Um, a lot of that is not even from the market overvaluing them, it's or valuing them highly, or like trying to go really quickly. A lot of that's more like those people often have like a really good network of existing network investors that were happy with the last company, and so the process ends up just being really fast of like, hey Luigi, you backed my last company, I did really well, do you want to back my next one? And you don't do a lot of diligence on me, you're just like, I like this idea, like, let's go wire a check in like 3 days. So there's those, but those are pretty rare. um, Most rounds I think happen over, at least at seed, pre-seed stage. I think like a month or two is pretty common. Um, Sometimes it's a little faster than a month, but not much. Like I rarely see deals happen in less than like 2 weeks or so. And on the flip side, it's pretty common to go over 2 months if it's, if it's an industry people don't understand, or maybe like, you know, I'd say especially for like teams without experience in the industry, sometimes it's a bit more of an uphill battle to convince investors to invest. So I have seen rounds also take like 3, 4, 5, 6 months, but like one or two is pretty common. I think on the SaaS and AI side, I think a lot of stuff happens in days or weeks, from what I can tell.
Given also, let's say that the kind of the disparity in like how quickly capital gets deployed, even at the early stage, uh, what do you think would be valuable for early stage deep tech companies to, be able to navigate that, quite a bit longer maybe, uh, sales cycle when it comes to raising capital? Like, is it like raising, like how crucial is it maybe to get non-dilutive funding? Like, what are things that you look at with their ability to maybe stretch through in that early phases?
Yeah, I think access to non-dilutive funding, or not access in terms of network, but maybe more like, does the company have elements that are like easy to fund non-dilutively? Like that's always an interesting angle. I'd say specifically, like a lot of times, like if you're buying equipment, right, you're like, oh, we need this like, $500,000 special CNC machine. A lot of times, like you can get debt to finance that, because somebody will, lend against that machine because they can repossess it if if things don't work out, they can resell it for like 450,000 instead of 500,000. So you don't have to put 500,000 down. Maybe you put down 50 or 100, and then the rest is financed at like a reasonable rate. So I think that kind of equipment financing and debt financing is really valuable. I think the other thing that's really valuable from a financing standpoint is just to have like good, meaningful milestones between rounds, right? So I think, especially as you get up in the rounds, like if you don't have commercial traction, you have to get people really excited about the tech progress, right? Because, at series, like let's say at seed, you could basically say like, I have this technology I'm building, it's going to be really valuable. We have a great team that works well. At Series A, if it's kind of more of the same, right? Of like, well, we're still building this cool technology, we still have a good team, like we don't have any revenue. That's a bit of a harder pitch, right? And so people are really looking at the progress of the team getting better, and like and the hiring, and then also the progress on the tech. But as you get into like Series B and C, like it gets harder and harder, right? Because so at some point somebody's like, well, it's a Series C, I can invest in this company doing like 40 million ARR, 20 million ARR, or I can invest in this company that's been working on the tech for 7 years. And you can imagine that that first investment just like is much easier and safer and more straightforward. And so you really need these concrete milestones. And what I mean by that is like, like let's say you're building, like a quantum computer or something, right? And like going from 0 qubits to 1 qubit is very good, right? Like that's like a big step. And so if you're going from seed to Series A and you're like, well, we're still at 0 qubits, like we're still just working on the design, that's like a little bit harder to underwrite. If you're like, oh, we have our first qubit working, now we're going to raise a Series A and we're going to go from 1 to 100. Like that's pretty interesting, right? Or, on the flip side, if you're like, well, we have 1 qubit working, now we're going to do research for the next couple of years, and the Series B is also off of 1 qubit, that's very hard, right? Because again, like the next round investors, they want like tangible milestones, and they want to kind of map out the momentum, right? And feel like, okay, you did this much in a year with this much funding, you're going to do this much more in the next year or two with this much funding. And like based on this kind of progress, I think you'll have a next round. The next round will be more valuable. You're going to like build a successful company. And if they don't feel those things, like, a lot of times, like they might decide to either just pass, or maybe they're interested, but they feel like the next round would be better because they don't think your valuation will go up a lot because you're not hitting any like concrete milestones. So I think that milestone planning thing is really important.
What's a non-obvious moment in the entire, say, deal process, maybe a small detail that ends up mattering way more than you expect or that you expected in, say, in your experience or career?
This one's kind of silly. I'll talk about this from like the investing side, like from the investor angle versus the founder angle. I found that like explaining what people do back to them is really valuable. uh, and like I sort of stumbled into this because I think in the early days, like if we want to invest in somebody's company, we'll get on the phone, we'll be like, "Hey, Luigi, like we've really enjoyed chatting for the last couple of weeks. The whole team's excited. Like we love that you know, you're building like these nuclear reactors for defense. We like that you're doing it for defense and not space, and we love that you can do this and this and this with your like $3 million raise." And we were just like trying to explain to people why we were excited. Um, but then we found like over time that sometimes, somebody would have like 4 or 5 term sheets and they'd pick us. And once in a while I'd be like, "Oh, like we're super excited and grateful that you picked us. Just wondering like what made you go with us versus like, some other brand that we like know is like a good brand or some other investor we respect." And a lot of times investors would just be like, "Yeah, like or the founders would be like, I talked to the investors. I think they're excited about us, but I feel like they don't really understand our business, or like they're just investing because like, things look good on paper. Like I'm a good founder, but like they didn't really like dig in that much. And we really like that you tried to like really get the business. Like you can explain this vision and strategy back to us. You're aligned on the strategy. So I think that kind of alignment, like, and just expressing it has been really valuable. And it's not something I expected. I thought it was just like, hey, I'm going to tell somebody why I'm excited, but it ended up being almost like a differentiator, right? Where like we try to really get what you're doing and be aligned with it versus, just kind of like FOMOing in. And I think that's something that founders have valued. And so now it's like a more active part of our process, right? Where when we invest, we tell somebody why we're excited, like where we're aligned on their vision, where we think maybe like we wonder if there's something different they should do, et cetera.
That's fantastic. I'd love to touch upon a little bit kind of your path to this moment. Was there a turning point or a moment where it kind of all clicked and enabled you to start this journey as a VC and, back at Susa? And what was that moment maybe for Humba to make that jump?
Yeah, absolutely. So for Susa, frankly, like a lot of, I'd say like half the VCs I know kind of went into VC very deliberately, right? Where it was a career they were interested in, they figure out how to get in, and then they stayed here. The other half sort of stumbled into it by just happenstance, and then ended up liking it. I'm more in the second group. So my background's I used to be an engineer, a software engineer. I was one of the first hires at LinkedIn in the early 2000s. Then worked at Google. Then worked at a startup called Factual that was kind of same stage as LinkedIn when I joined. It was about 15 people at both companies. It was like 50, 60 when I left. So I saw this like Series A and B phase at LinkedIn and Factual. I liked startups a lot. I felt like small companies or like growing companies were like more exciting to me than like a Google size or Microsoft size company. And so I was thinking about starting something, but I felt like I'd never seen seed stage. I'd only seen Series A and B and later. And so I wanted to learn more about seed stage and like what does it take to get a company off the ground from day one versus maybe day like 400. And I kind of just got lucky because one of my teammates from Factual was leaving at the same time as me. And she approached me and she was just like, "Hey, I'm angel investing with some friends. We kind of want a tech person to help us with tech due diligence. Do you want to try it out just to see if you like it and you could help us with the tech due diligence piece?" And I thought that would be like a really fun learning, approach to seeing how early stage companies are built. And so I thought I would maybe do angel investing for like 6 months with my friends, and while like I lived off of ramen, and then I learn a lot and then go start a company. Instead, I ended up just really falling in love with venture, and so we angel invested in this group for about 6 months, 8 months. Then we ended up starting Susa Ventures together. That was back in 2013. And so I love venture. I kind of like, dropped the idea of being a founder. I think I'm probably a better like founder supporter than founder. Um, and then on the Humba side, basically what happened was like, as an engineer, I've always liked the more deep techy, sciencey startups. But I think like, 6, 8, 10 years ago, they felt pretty hard to invest in. Most of the founders were like, lots of academic experience, very little industry experience. There's very little follow-on funding. So if you didn't raise from like, Khosla or Founders Fund or Andreessen, like you basically ran out of money at Series A very quickly. And then finally, like I think a lot of the companies were pretty capital intensive to start. So it's like you kind of need to go raise like 10 or 15 or $20 million because just like all the hardware stuff is so expensive. And then I think like 4 or 5 years ago, I started seeing all of that just slowly changing. So there's more and more follow-on funding, more and more funds doing Series A's and B's in deep tech. There are more founders with industry experience where they're coming out of like, Palantir, Anduril, Tesla, SpaceX, like all of these companies where they had like really good industry experience. They could apply it to some other, deep tech area. I thought that was really cool. Um, and then finally, I think that just the cost of everything kept dropping, right? So there's this like Moore's law for software where, you know, like all of the chips get like, twice as good every 18 months or whatever it is. I think you get the same thing for hardware, right? Like robot arms keep getting cheaper and cheaper. Space launches per kilogram get cheaper and cheaper, gene sequencing, like all of this stuff. And so the thing you needed like $10 million for, 10 years ago, maybe you needed like $5 million for 5 years ago, and now you need like $2 million. And so that just makes it a lot more accessible to seed investor, because it's like companies need less money up front. The people have like, the founding teams have a lot of industry experience, so they build quickly. And then there's a lot of follow-on capital waiting for them. And so I think those are just like really good ingredients for investing. And that was what made me start Humba 3.5 years ago.
And when looking back at your journey, what does being a VC mean to you? Like beyond the deals, beyond the returns, beyond working with a bunch of friends and supporting incredible founders.
I actually do think a lot of those are a big part of it, right? Like I love how long term the industry is, right? It's less of a like, hey, we have a legal transaction, maybe we, work together for a week and then that's it. It's like a lot of these relationships, I'm like 12, 13 years in now, and there's founders where, we invested back in 2013 and we backed them again, or like, we still talk on a regular basis, like kind of watch them build companies and have exits and get married and have kids. Like I think that part is really fun, both with founders and with co-investors. Um, I think seeing the impact is something I really enjoy, right? So, in the early days of Susa, for example, we invested in Robinhood, and we're really fortunate to like meet them early on and get a chance to invest. But I think it's been like just amazing to see how much impact they've had on the brokerage industry. Like they basically like upended the whole industry over 10 years, and I think a very positive way for consumers. Where now there's like no more, $30 Schwab trading fees or like Fidelity trading fees, and like everything is like nice UX. And I think all of those changes are so positive, and I think a lot of that's traced back to Robinhood. And so it's just cool to see like a company we worked with have that kind of impact. Um, and on the deep tech side, I hope to basically like work with a lot of companies that have that kind of impact in their industries over the next 10, 20 years. Maybe I guess last thing I'd say is like on the personal front, I just want to feel like I can like help people and accelerate their careers or their impact a bit. Um, I mean this in sort of like an impactful way and not a narcissistic way, but I hope in like a few decades there's like a handful of founders that would say that like I really helped them like, like build a big business or transform some industry, and like they're not sure if they would have gotten as far along without like Humba support. I think that would make me really happy to know that we had that kind of like positive impact on somebody.
Yeah, I am sure. I'm sure that will be true. Well, Leo, I really want to thank you for your time today. It was really insightful, really inspiring, and listeners, thank you all for tuning in, and we'll catch you next time.
Thanks, Luigi. Really, really happy that you invited me in. This is an awesome conversation.
Thank you so much. All right.